There are moments in history when markets drift quietly, almost lazily. And then there are moments when something shifts beneath the surface and the entire structure begins to strain. Not with a headline, not with a panic on television, but with a subtle change in behavior, a change in who is buying, a change in who is selling, a change in what is being trusted. Right now, if you hold silver, you are standing inside one of those moments. Before you go any further, make sure you like this video, subscribe to the channel, and turn on notifications so you never miss what's coming next. Drop a comment below telling me where you're watching from and what time it is in your country right now. Now, let's return to the topic. Most people still believe they own silver when they own a ticker symbol. They believe they own it when they hold an ETF share, a futures contract, a brokerage allocation. They believe that because the system has trained them to equate paper claims with physical possession. But silver is not a number on a screen. It is not a derivative. It is not a promise. It is a metal. And the difference between a promise and a metal is about to matter more than at any time in the modern financial era. Let us begin with the imbalance that almost no one wants to talk about publicly. In the silver market, there are often close to 100 paper claims for every 1 ounce of physical metal that can actually be delivered. 100 claims. 1 ounce. Think about what that means. Imagine a warehouse with 1 bar of silver in it. Now imagine that 100 separate contracts have been written against that same bar. Each contract holder believes they have exposure. Each contract holder believes they can exit when they want. But if even a fraction of them demand delivery, the illusion collapses. This structure has worked for decades because most participants never intend to take delivery. They roll contracts, they trade spreads, they settle in cash. The entire system depends on the assumption that the paper will not be tested. It depends on confidence. It depends on inertia. But confidence changes when the world changes. When geopolitical tension rises, when trust in currencies begins to erode, when sovereign debt balloons beyond comprehension, capital does not stay in paper. It seeks tangibility. It seeks assets without counterparty risk. And that is when a 100-to-1 imbalance stops being an abstraction and starts becoming a fault line. What is happening now is not a speculative frenzy in the traditional sense. It is not retail traders piling in on leverage. It is not momentum algorithms chasing headlines. It is something quieter and far more consequential. Capital rotating out of paper exposure and into physical metal. And that rotation is exposing stress in the exchanges. Consider what happens when a large short position develops in a futures market. On paper, that is normal. Shorts provide liquidity, they hedge, they speculate. But when a concentrated short position meets tightening physical supply, the dynamic shifts. If the short cannot add to the position, cannot roll easily, and cannot rely on abundant metal in the background, the risk of a squeeze increases. Now add a holiday closure. Add a period where the exchange is shut, but the global market is not. Add a situation where a large short must either buy back contracts or prepare to deliver metal in a tightening environment. That is not theoretical volatility. That is structural vulnerability. The danger is not just a price spike. The danger is a break in confidence. Because if one exchange suspends accounts for spoofing, if regulators begin scrutinizing sudden waves of options activity, if bid-ask spreads explode from cents to dollars in a market that is supposed to be liquid, participants begin asking uncomfortable questions. Is the liquidity real? Is the metal there? Are these prices the result of natural supply and demand, or are they artifacts of leverage layered upon leverage? Spoofing allegations have shadowed precious metals markets for years. Large orders placed, then canceled. Artificial pressure created to push price in one direction. Puts stacked ahead of sharp moves. Calls layered to trigger stops. In normal times, this behavior is absorbed by the system. Fines are paid, activity continues, the machine hums along. But when physical demand rises simultaneously, when large buyers step in on every dip and remove metal from the available float, spoofing stops being a side story. It becomes gasoline near a spark. And this is where the deeper layer emerges. For decades, the global monetary system has revolved around sovereign debt and fiat currency expansion. Governments issue debt, central banks monetize it, liquidity expands, asset prices rise. This cycle reinforced itself because confidence in the underlying currency remained intact. But confidence is not infinite. When sovereign reserves are frozen, when payment systems are weaponized, when sanctions sever countries from financial plumbing, trust erodes at the margins. Not overnight, not with fireworks, but slowly, strategically. And when trust in paper promises erodes, physical assets become more than commodities. They become collateral of last resort. There is a reason central banks have been accumulating gold at the fastest pace in modern history. There is a reason wealthy families with generational memory understand the distinction between money and credit. Credit is someone else's liability. Money, historically, has been something without counterparty risk. Silver sits in a unique position in this shift. It is both monetary and industrial. It is small relative to gold and total market size. It is thin compared to global bond markets. That thinness is precisely what makes it volatile when flows shift. Now consider another dimension, the reclassification of critical minerals. When a metal is labeled strategic, it is no longer merely an investment vehicle. It becomes a tool of policy. Supply chains matter. Export controls matter. Domestic stockpiles matter. If one side of the global divide reduces exports or redirects supply internally, the impact on pricing mechanisms elsewhere can be severe. At the same time, there are signals that major institutions are being directed to reduce exposure to certain foreign sovereign bonds. When a nation reduces purchases of another nation's debt, the implications extend far beyond yields. It signals a strategic decoupling. It signals preparation. It signals that holding paper issued by a rival may no longer be considered risk-free. If institutions are told to reduce sovereign bond exposure and avoid speculative digital assets, where does capital go? It does not evaporate. It reallocates. Commodities become a natural destination in an environment of strategic tension, especially commodities with limited above-ground inventories and monetary history. This is why the argument that this is just another gold bull market misses the point. It may not be a bull market in metals at all. It may be a bear market in fiat currency. The distinction is critical. In a traditional bull market, an asset rises because demand increases relative to supply. In a currency bear market, everything priced in that currency appears to rise because the currency itself is losing purchasing power. The asset is not necessarily becoming more valuable. The measuring stick is shrinking. If the measuring stick is shrinking, while base metals are historically undervalued relative to gold, the implications are explosive. Measured in gold, many industrial commodities trade near multi-decade lows. If gold's purchasing power remains relatively stable over long horizons, then either gold must fall significantly or industrial commodities must rise dramatically to close that gap. In an environment of currency debasement and infrastructure demand, the latter scenario carries weight. And when industrial metals rise, they do not stay confined to trading desks. They move into producer prices. They move into manufacturing costs. They move into energy infrastructure. They move into consumer goods. Inflation is often misunderstood as rising prices, but more accurately is the loss of purchasing power of currency. When input costs rise across the commodity complex, the pressure does not disappear. It compounds. Looking into 2026 and beyond, the risk is not merely headline inflation. It is a structural repricing of real assets relative to paper claims. Now return to silver. If you have 100 paper claims per ounce and physical demand continues absorbing available supply, the leverage ratio becomes dangerous. The system can function only as long as the majority are content with cash settlement. The moment a critical mass demands metal, the exchange must either source it at higher prices or force cash closure. Either outcome undermines the illusion of abundant liquidity, and illusions, once broken, are difficult to restore. This is why short squeezes in physically constrained markets are different from equity squeezes. In equities, new shares can sometimes be issued. In futures, contracts can be cash settled. But physical silver cannot be printed. It must be mined, refined, delivered. Mine supply is not infinitely elastic. Bringing new production online takes years, capital, permitting, and geopolitical stability. Recycling flows depend on price and economic conditions. There is no central bank printing press for silver. So when strategic actors begin accumulating, and when paper leverage remains elevated, you are looking at a system where small imbalances can produce outsized moves. This is not a prediction of tomorrow morning's price. It is an analysis of structural stress. Markets today may be pricing rate cuts, soft landings, orderly adjustments. But markets often misprice structural change until the moment they cannot. Gold rising steadily while currencies weaken is a signal. Silver lagging and then tightening is a signal. Premiums in one region exceeding those in another is a signal. Exchange suspensions and regulatory investigations are signals. When you assemble them together, they do not read like a routine cycle. They read like preparation. Preparation for reduced trust. Preparation for currency volatility. Preparation for a world where paper assets are no longer assumed to be safe simply because they are familiar. If you hold physical silver, you are not holding a trade. You are holding an asset without counterparty risk in a system built almost entirely on counterparties. The warning is not to panic, it is to understand. Understand that the paper to physical imbalance is real. Understand that geopolitical realignment is accelerating. Understand that commodities relative to gold are historically depressed. Understand that inflationary pressure into 2026 may not be transient. Understand that when capital flees paper into physical, the process does not reverse quickly. The early stage of a financial conflict does not look like chaos. It looks like anomalies. It looks like strange premiums. It looks like regulators asking questions. It looks like liquidity disappearing at the margins. By the time it looks obvious, the repricing is already well underway. And that is why silver holders must listen carefully now, not later. When capital begins leaving paper markets for physical assets, it does not announce itself with sirens. It shows up in subtle distortions. Premiums separate between regions. Lease rates spike. Bid-ask spreads widen in markets that are supposed to be deep and liquid. Delivery requests rise quietly in the background. Warehouses show drawdowns that analysts dismiss as routine. But when you connect these dots, a pattern forms. If the paper-to-physical ratio in silver sits anywhere near 100 to 1, then the system is mathematically dependent on complacency. It requires the overwhelming majority of participants to remain satisfied with financial exposure instead of demanding metal. It requires confidence that contracts will settle smoothly. It requires trust that the exchange can always source supply. Now introduce geopolitical acceleration. When a major power signals to its institutions to reduce exposure to foreign sovereign debt, that is not portfolio rebalancing. That is strategic repositioning. When speculative digital assets are restricted or banned domestically, that is not random regulation. That is capital control. When exports of strategic materials are limited or redirected, that is leverage. This is what financial war looks like in its early stage. Not tanks, not headlines, capital directives, trade adjustments, quiet instructions behind closed doors. And in that environment, commodities become both shield and sword. Gold has already signaled this shift. Central banks have been accumulating aggressively, not because they expect quarterly gains, but because they understand systemic risk. They understand that reserves held in another nation's currency can become political tools overnight. Silver follows gold, but with a twist. Silver's market is smaller. Its above-ground stockpiles are thinner. Its industrial role is critical in electronics, energy infrastructure, solar, and advanced manufacturing. That dual identity, monetary and industrial, creates a pressure point. If industrial demand remains firm while monetary demand rises, the squeeze intensifies. Consider the undervaluation argument. Measured against gold, a broad basket of base metals sits near historic lows, roughly 20% of long-term value relationships. That is not a small deviation. That is an extreme. Either gold must collapse relative to commodities, or commodities must reprice upward relative to gold. In a world where currencies are being debased to sustain debt loads, and where infrastructure competition is accelerating globally, the probability favors commodities rising, not gold collapsing. If that happens while gold itself is rising against fiat currencies, the compounding effect is severe. Producer prices would not edge higher, they would surge. Energy costs would not stabilize, they would reprice. Manufacturing margins would compress. Governments would face a choice: allow recessionary pressure, or expand monetary stimulus further. And if they expand monetary stimulus further, the currency weakens more. This is the feedback loop that turns commodity undervaluation into currency instability. Into 2026 and beyond, the risk is not a mild inflation bump. It is a second wave, one driven not by temporary supply chain disruptions, but by structural repricing of tangible inputs. Oil could double or triple in an extreme scenario. Industrial metals could multiply relative to current levels. Not because of speculative mania, but because years of suppression and underinvestment meet strategic hoarding and currency debasement. Now place silver back into this equation. If industrial metals reprice upward 4 to 5 times in gold terms, and gold itself rises against fiat currencies, silver's upside potential becomes nonlinear. But more important than price is availability. In a stress environment, paper markets can remain open while physical dries up. Cash settlement can mask delivery strain. But if premiums widen enough between regions, if one exchange consistently prices silver higher than another, arbitrage becomes difficult when physical supply is constrained. We have already seen moments where liquidity in Western hubs tightens while Eastern premiums expand. That divergence matters. It suggests that price discovery may be migrating. If price discovery shifts toward markets that emphasize physical backing rather than leveraged derivatives, the 100-to-1 paper structure becomes increasingly fragile. Add regulatory scrutiny to that equation. When authorities begin investigating unusual options positioning, spoofing behavior, or concentrated shorts, it signals discomfort. It signals that the volatility is no longer being contained neatly. If margin requirements are raised sharply, even toward extreme levels, leveraged participants are forced to reduce exposure, and forced reduction in a tight market can create violent price swings. Short squeezes are not gradual. They are abrupt. They are driven by the urgent need to buy back positions at any available offer. If a large short is trapped during an exchange closure, unable to add to positions and facing delivery risk, the reopening can be explosive. But beyond the immediate mechanics lies a deeper truth. The system is leveraged far beyond the underlying metal. That leverage worked in an era of trust. It becomes dangerous in an era of distrust. If even 5% of paper holders demanded deliveries simultaneously, the exchange structure would strain. If 10% demanded delivery, emergency measures would likely be invoked. Cash settlement clauses would be tested. Force majeure language would be examined. And what happens to confidence when investors realize their silver exposure is not silver? The shift from paper to physical is not emotional. It is rational in an environment of counterparty risk. It is rational in an environment where sovereign debt exceeds sustainable levels. It is rational in an environment where geopolitical rivals are openly repositioning reserves. This is not about short-term charts. It is about systemic architecture. The bond market remains the foundation of the global financial system. If major holders reduce Treasury exposure materially, yields must adjust. If yields adjust upward while growth slows, fiscal stress intensifies. If fiscal stress intensifies, monetary expansion resumes. And when monetary expansion resumes, currency purchasing power erodes further. Gold front-runs this process. Silver amplifies it. Markets today may appear calm. Equity indices may hover near highs. Commentators may speak of rate cuts and soft landings. But beneath that surface, commodity inputs are coiling. Physical demand is firming. Strategic reserves are being reconsidered. And this is why the warning matters. Silver is not just a trade. It is a pressure valve for systemic risk. It is small enough to move violently. It is essential enough to matter. It is leveraged enough in paper form to snap. If this truly is the early stage of financial conflict, capital controls, bond reductions, commodity repositioning, then the repricing of tangible assets will not be polite. It will be fast. It will surprise the majority. And it will reward those who understood the difference between owning a promise and owning a metal. This is not about fear. It is about structure. When paper claims outnumber physical silver by 100 to 1, when geopolitical tensions accelerate, when institutions reduce exposure to sovereign debt, when commodities sit at historic undervaluation relative to gold, and when inflation risks build into 2026 and beyond, the message is clear. We are not witnessing a normal cycle. We are witnessing the slow fracture of a paper-dominated system and the early repricing of real assets. If you hold silver, understand what you hold. Not a ticker, not a derivative, not a line item. You hold an asset outside the promise structure. And in a financial war, that difference can mean everything.